Hello and welcome to this week's edition of Murphy's Market Minute with Elliot Omenson and
Nathaniel Vossman.
it is Friday, October 10th,
Indeed.
right? End of the year is coming up. We got 5 more days until corporate taxes are due, right? Today, I'm going to do a little bit different of approach on Murphy's Market Minute because I'm always looking for negatives, right? Or not necessarily negatives, because a lot of times things have two sides to them, right? And so I just think there's a lot of interesting things to touch on today, and I'm not necessarily going to paint what I think is a clear picture, but I'm just going to make you guys aware of some stuff that we're paying attention to, and we'll get into it. But first, let's start with what happened this morning. Nathaniel, what happened this morning?
Oh, just that China, I guess, had announced that they're putting restrictions on some of their rare earths materials. So because of that, we're looking at probably a pretty hefty tariff that we're going to be placing on them, which obviously the stock market doesn't really love. So you see all the major indices.
Everything went red today.
Yeah.
And I think it was up before that happened.
Yeah, it was. It was up, I don't know, maybe like half a point. Now it's down at least a point and a half.
Yeah. What do you think that's gonna? What do you think is gonna happen on Tuesday? Because isn't Monday the market's closed for
Federal
Columbus
holiday.
Day?
Yeah.
And we're closed as well Monday.
I don't think I don't really see it being that big of an issue. It's not really much different than a lot of the stuff that's already happened this year.
Yeah, it's interesting to me that the markets react that way, considering it's been the story for 10 months now.
Yeah, because this whole rare earth thing is just China's version of what we're doing to them.
Yeah.
So it's just the two sides fighting each other.
Yeah. And, there was a term that was created around nuclear warfare, mutually assured destruction. And it doesn't just apply to nuclear warfare, it applies to economic warfare as well. And so I think my personal opinion, what you've been seeing is for years under the idea of globalism and this idea that because we have it so much better than everybody else, it's our job to kind of take it to shorts and help prop all these other countries up. As that's been getting reversed, you're obviously going to get pushback. And depending on the size of the country, the size of the economy, the amount of trade goes back and forth between us, the more pushback they might feel they're capable of doing. But ultimately, I don't really believe anybody has the ability to push back. So I think they can attempt to. But I think eventually it all goes our way.
Yeah. It's just, like I said, I feel like it's not really that much different than what's already been going on. It's this whole year has just been a pretty big negotiation between China and U.S. And I think we still have a long ways to go, though.
Yeah. And so they did some stuff with rare earths. They opened an antitrust suit into Qualcomm. They increased port fees. So China's bucking up, and we'll see what happens. Now, into some more interesting things. And like I said, I can't really paint you a clear picture of what's happening, right? But I think consumer outlook has been kind of stagnant. I think 55 to 55.1.
I think it's 55 today.
Yeah. And the higher the number, the better.
Yeah.
Right? So ideally, you'd like it to be 100. We'd all be delirious on Prozac or Xanax.
Something like that.
Okay, so it'll never be 100. But there's some interesting, and the one thing I'm gonna try to do is put it in perspective for the bulk of our clients who are retired, right? Because I actually think that, and I was gonna sound horrible, but remember, my job is to focus on you guys and not necessarily, I'm not out there, concerning myself with the well-being of people in other countries or when it comes to this job, right? Or even people inside of America who fall outside the bulk of my clients' demographic. So it's not that I don't care about all those people. It's just that my primary focus and concern is managing and taking care of our clients, right? So I was reading this interesting post. It talked about how Americans have stopped spending. Credit card balances fell in August, and new borrowing barely grew at all. Consumer credit inched up a mere 0.1% for the month, not something we're used to seeing outside of the start of a recession. This might be the first real sign the consumer engine, the one that's kept the economy humming the last couple of years, is finally starting to stall. Everyone looks at GDP and employment data to forecast recession, but consumer spending is probably the most reliable leading indicator. All right, of course, it's in a shutdown, and so the government's not releasing retail spending data. All right. Now, personally, I think it's fantastic credit card. Consumer credit isn't going up. Like, heaven help us if we started to behave responsibly.
Yeah.
Okay. But as a leading indicator, it's still a leading indicator, responsible or not. Now, another really interesting thing that came out is that when you subtract out AI and data centers, did you see this?
No.
It's reduced GDP growth for the first 2 quarters down to 0.1%. Okay. And it was a study that came out, I think somebody at Harvard. Not that that really matters, but let me just see if I can pull that up real quick.
Yeah, one thing on the spending that you were talking about, like the credit card or the credit, how much credit the consumers in the country have, like that's something that's been down since this time last year. So it's not even like this past month is unique in that sense. Like October 2024 is the peak, and then it really dropped off going into the new year.
Yeah. And so in Fortune, this study was published, Harvard economist Jason Furman, that in the first half of 2025, U.S. GDP growth without data centers and technology investment would only be 0.1% annualized. All right. So why does that matter? Well, how long can investing in data centers and AI comprise your entire GDP, basically, right? That's the question there, right? Then let's add another conversation to here about gold. And this one is a little more difficult to read the tea leaves on because gold can be impacted by 2 things, right? The price of gold is viewed as a safe haven in times of economic instability, but it's also where you'd be moving money to as interest rates come down. When yields are high, you're going to move for people who are safe investors, institutions, things like this. If I can get a good yield on bonds and CDs, well, I'm going to put it there. But as those start to drop, I might move it out and move it over to gold. So is the fact that gold cracked $4,000 an ounce, is it a predictor of a coming recession, or is it just in line with interest rates falling? Right?
Yeah. I mean, it's been going up for quite a while now, though.
Correct. But it just gets more attractive when real yields, interest rate minus inflation, falls or go negative. In addition to that, it also becomes attractive as the U.S. dollar softens. All right. And just so you know, there is no, I don't personally believe the U.S. dollar being strong or the U.S. dollar being weak, you can say is good or bad. There are positives and negatives to both those scenarios. There's positive and negatives to it being strong, there's positive and negatives to it being weak. But a softer U.S. dollar makes gold cheaper for foreign buyers, which supports demand. So there's 3 things that are impacting the price of gold: interest rates, fears of recession, and a weakening U.S. dollar. Right. So I wouldn't really necessarily say it's all signs of coming recession or anything like that. Do you have any statistics on what the poly markets are saying the odds of recession in the next 12 months are?
Probably still pretty low. But on that gold note, it is interesting because we're talking about being safe haven. Sure enough, in the last 2 hours, the stock market's way down and the gold's spiking up.
Yes. Well, yeah, because one of the things that drives me nuts about reporting on stock market, right, is they'll be like, COVID comes and hits and, X number of trillions of dollars evaporated. No, it doesn't evaporate.
Yeah.
It moves.
It just moves out of the market and then come right back in.
Yeah. So it either goes and the market is always where you want excess capital because that's where you get the best growth, right? Well, private equity, then the market, right? and you'll move it to somewhere like gold or to bonds or to your bank account for cash, in times of instability, uncertainty, or higher interest rates or something like that. But it didn't disappear. It just moved. And it's still sitting there, just in a different form, waiting to move back. All right. So now, though, to kind of pull all this together, everybody, I just want to address usually what most people's fears are, especially as they see gold going high or the stock market dipping due to tariffs and all the conversations around, tariffs hurting the economy and all that kind of stuff. What's really and like I said, there is no good or bad. There's just good and there's just both sides of a coin existing simultaneously in just about every scenario. Okay. So, if you're retired, okay, and the economy pulls back, we enter in a mild recession or whatever. In fact, the last time we hit a recession, nobody could tell. You remember that? They actually had to start changing the definition of recession. It was just within the last couple of years. We had 2 quarters of negative GDP. Yeah. Right. Which technically is the definition of a recession, but nobody was willing to call it that, because even though we had 2 quarters of negative GDP, it didn't really impact anybody. Right. Yeah. Do you remember that?
Yeah.
Right. So obviously the thing that would impact our clients, right, is stock market declines. Okay. And then another thing that could, but not for most of our clients, because I'm not a big fan of bonds and we don't hold a large position there. But if the stock market was declining and the Fed was cutting interest rates, but that's that's a really wild scenario, because usually when the Fed cuts interest rates, the stock market's going to go up. Right? It's cheap capital to invest and grow your business usually results in the stock market going up. You could see lower dividends as pressures put on companies because their profits are lower. All right. And we do some div portfolios. Home values can flatten or dip, right? As if the economy stagnates and it's harder for people to buy houses. But again, that is offset by lowering interest rates. All right. But here's what really ends up happening. Usually in a slowdown, what happens to inflation?
When it's slowing down, inflation will calm down a little bit. Exactly.
So for a retiree, right, the best of both worlds would be for the economy to start to get kind of bad. I don't mean bad. I just mean kind of bad. The Fed cuts interest rates. That keeps your portfolio propped up. But the lowering of the sagging inflation, the sagging economy would lower inflation. So now your portfolio is still good and your cost of living is going down. So it's just kind of interesting to me how there is scenarios within these things where it looks bad on the surface, but when you at a macro level, but when you bring it down to your specific situation, it actually could end up being positive, right? And I'm never for a bad economy. I'm just saying it wouldn't be bad to get inflation even lower than what it already is, right?
Yeah.
Now, inflation going lower is going to decrease your Social Security because it's inflation adjusted, but that's offset by inflation, so who really cares? It's not really, when you get a increase in your Social Security, you're not getting more purchasing power. In fact, since Social Security is not a large part of your income, it's actually, if you're getting a huge increase in Social Security, you're most likely getting hosed because the remaining 60, 70, 80% of your spending power is getting decreased.
Yeah.
So, anyways, anything to any of this that you'd want to add?
No, just circling back around those recession odds. So I'm looking on Kalshi. So it's the same kind of website as Polymarket, but says odds of recession before 2027 is 33%.
Okay.
It's kind of hard to see for 2025 because we're getting close to the end of the year.
Yeah. I mean, yeah. I don't think in 2 months.
Yeah.
we're going into a recession or anything.
Yeah.
I could see a pullback usually at the end of the year. A lot of people sell off assets to cover tax bills and stuff like that. And then you never know what the whole tariff thing that's going on. But anyways, I just want people to know that we're, trying to read all the tea leaves, sort through all these things. But more importantly, we're looking at it from the lens of our specific clients and how it may impact them and whatnot. And so we're kind of heavy tech. So one of the things that I'm watching for is, how much legs does the run on tech have? What out there could impact that and cause it to pull back? So anyways, that's kind of where I'm at. Who are the Chiefs playing this weekend?
I know they play Sunday night.
That Jacksonville Jaguars game had me literally, I didn't mean to, but I launched my phone when the Jacksonville quarterback fell twice and somehow still made it into the end zone. I was so like, what am I watching happen right now?
A little disappointing because then, now this week we're going in Sunday Night Football against the Lions.
Oh, this is the Lions. So most likely we're about to be 2-4. 2-4?
If we lose, but hopefully not. But yeah, that'll be a good game. Tough game, but a good game.
Yeah. So, all right. So, for those of you that care, this should be a interesting weekend for football. And if you have any questions about anything we talked about, feel free to hit us up. And then, as always, we're pushing our reviews on Google. There's a link. You just click it right in the email. Yep. And, you can say whatever you want about us. Just give us 5 stars.
Amen.
All right, everybody. Love you all. Take care. This is Elliot.
Nathaniel.